You're looking for stability. You're looking for income. And then you see it, a real estate investment trust, a REIT, promising this scorching dividend yield, maybe 8%, maybe even 10%.
Yeah.
Now, as an investor, you have this immediate kind of conflicting reaction, right? Is this a generational buying opportunity, or is it the flashing warning sign of a cleverly disguised trap?
That is the ultimate choice in this market, absolutely. And that's why we're diving deep into the source material you provided us. Our mission today is really to give you a shortcut to understanding the whole REIT ecosystem.
Right.
We want you to walk away knowing how to spot, sustainable income that will compound over decades versus that high-risk yield trap that often uses financial engineering and, frankly, leads to permanent capital loss sometimes.
Okay, that sounds like essential protection. The yield promises are definitely tempting, but before we buy it, we really need to know what kind of building we're actually buying into. So let's unpack this by first understanding the diverse sector personalities within the REIT world, because the risk starts with the asset itself, doesn't it?
Absolutely, yeah. When you look beyond just the yield percentage, you see huge differences in risk profiles based on the underlying real estate. Take the traditional sectors, like retail and office. These often hold prime urban assets on very long leases, sometimes, 99 years. They're fundamentally tied to big economic cycles, consumer spending or business demand. And office, especially, is facing structural challenges now due to hybrid work trends.
And then you have the sort of darlings of the pandemic era, industrial and logistics, right?
Yeah.
The warehouses and distribution centers driven by global supply chains and e-commerce. You often see a higher yield attached to these, but why? What's the catch hiding in the fine print?
Well, the catch is often lease tenure, especially in concentrated markets like Singapore. While they sound great, many industrial properties operate on shorter local leases, often 30 years, maybe extendable to 30 plus 30.
Okay.
The reason that higher yield is offered is basically to compensate investors for the inherent risk of having to renew, redevelop, or even return that land once the full tenure expires. That eventual renewal or redevelopment risk is a major long-term factor that I think far too many investors overlook when they just see a high current yield.
That's a crucial distinction. The land is kind of running on borrowed time. Contrast that with hospitality, which owns hotels. Their income is highly cyclical, very sensitive to tourism and travel, meaning distributions can swing wildly.
Oh, absolutely.
It's the ultimate high beta play within the real estate world, isn't it?
Right. But then on the defensive end, you find healthcare REITs. They own essential assets, hospitals, medical centers, and are often backed by incredibly resilient, high-quality, long-term master leases, sometimes 15 to 20 years. That inelastic demand makes them very stable during downturns.
Makes sense.
And finally, you've got the specialized high-growth arena of data centers tied directly to the digital economy. Huge potential upside, but also, technology volatility can be a factor there.
So, okay, we've established that the building type defines the sector risk. But often the bigger risk isn't the asset itself, but maybe who owns and manages that asset. How do we spot the management strengths that separates a stable blue chip from a potential flop?
Yeah, this is where long-term survival is often determined. The blue chip REITs are defined by their sheer scale, their stability, and crucially, their parentage, their sponsor.
The sponsor, right.
They have large asset bases, incredibly strong, well-capitalized sponsors. Think Mapletree, Capital Land, Keppel, Fraser, a proven track record of stable occupancy, low overall gearing, and naturally much higher trading liquidity.
And when economic stress hits, like high interest rates, that difference becomes night and day, presumably?
Oh, completely. Blue chip entities have a cushion. For instance, sources show that even during recent periods of high interest rates, a blue chip retail REIT like Fraser's Centerpoint Trust saw its distribution per unit, its DPU, drop only mildly.
Okay.
That's because of that diversification and financial strength. They can absorb a shock.
But the non-blue chip peers, they lack that cushion. They're instantly vulnerable to single points of failure.
Exactly. Look at the data center sector again. When Digital Core REIT's major tenant, Cyxtera, filed for bankruptcy, the projected revenue loss was so concentrated that it threatened to cut the REIT's DPU by a staggering 22.4%.
Wow, 22%.
That single tenant concentration risk is the kind of vulnerability blue chip REITs usually manage to dilute down to almost nothing.
I think we need to emphasize that the risk for these smaller, non-blue chip players goes far beyond even a 20% DPU cut. We have seen historical examples where the results were, well, catastrophic because banks withdrew support, right?
Oh, absolutely. The Sazen REIT case during the global financial crisis is terrifying and instructional. Small cap REITs like Sazen cracked up to 90%.
Hmm.
When their debt matured, the banks, wary of smaller entities, just stopped refinancing them.
So what happens then?
To repay the loans, the REITs were forced to conduct desperate equity placements at rock-bottom prices. Imagine your unit was trading at $1, it crashed to 10 cents, and they still forced a massive equity placement at that 10-cent price.
That is just ruinous dilution. You lose 90% of your capital, and then you get severely diluted on the remaining 10% just so the REIT can survive the day.
Pretty much. That's the real threat investors miss when they just look at the high current yield percentage.
So failure cases like Eagle Hospitality Trust and Sazen REIT lacked those key defensive factors.
Exactly. The strong entities prioritize whale-weighted average lease expiry to ensure predictable cash flow, and they maintain balance sheet strength. Low gearing, longer debt maturity profiles, and highly fixed-rate debt to withstand interest rate shocks. These are critical.
Okay, now we get to the core of the danger for high-yield chasers, financial engineering. This is the mechanism that creates that seductive but ultimately fake 8% or 10% yield.
Yeah.
How do you define that manipulation for the listener? What does it actually mean?
Well, financial engineering is deliberately making a REIT appear to pay a high or stable yield that is not fully backed by genuine recurring rental cash flow. It is essentially a temporary sugar high designed to attract new money, often during an IPO or maybe when performance is flagging.
A sugar high. Okay, so let's list those specific maneuvers. For you listening, these are the immediate red flags that indicate someone might be artificially inflating the numbers. What are the common tactics used to juice those distributions?
Right. There are 5 major tactics, and you really need to know them cold. First, paying distributions out of capital. This is not earnings. It's literally the unit holder's own money being returned to them, masking a cash shortfall.
So they are sending you money, but it's money they should be keeping for maintenance or growth or money that was already yours in the first place. It's an unsustainable facade. What's the second tactic?
Frequent rights issues or private placements. They use this new equity fundraising to acquire assets and temporarily boost DPU, making it look like growth. But it often masks underlying dilution because they are just increasing the share count without proportional profit growth.
Right, so the pie gets bigger, but your slice might actually be shrinking in real terms. And often they push their debt limit to its absolute maximum to maintain that DPU.
Yeah, they do. The third tactic is using high gearing or issuing perpetual securities. These are debt-like instruments that help finance asset growth and allow the REIT to skirt just under the regulatory gearing limits, like the MAS 50% threshold, while maximizing payouts.
Wait, so they are essentially maxing out the corporate credit card and using instruments that look like debt but technically keep them compliant, all to maintain the facade of a large, growing dividend. Is that fair?
That's a perfect analogy, yes. The fourth tactic is aggressive asset recycling, selling off properties at a gain, not because it's strategically necessary, but purely to fund a temporary DPU top-up, rather than relying on consistent rental income.
Got it.
And fifth, they might use a sponsor distribution waiver, where the sponsor temporarily gives up its share of the distribution to make the public unit holder's DPU look artificially higher. It's temporary cosmetic surgery, basically.
Okay, that's a useful list. Now, before we move on to case studies, we must briefly address the separate, highly dangerous trap of business trusts. They look like REITs, they often pay dividends like REITs, but they are fundamentally different creatures, aren't they?
Very different. And what's crucial here is that business trusts pay distributions out of cash flow, not necessarily earnings. They can actually be loss-making, yet still churn out a high yield on paper.
How?
They often hold assets with fixed, finite lifespans, 30 years or less. Things like cable networks, shipping assets, maybe port rights. The long-term risk is structural. These assets are fully depreciated over their lifespan, meaning the net asset value, the NAV, will decline straight towards zero over those 30 years.
So investors who miss that NAV decay are effectively facing the slow structural erosion of their principal. That's why understanding the underlying asset lifespan is everything.
Wow, exactly. And the consequences of these traps, both financial engineering and these structural issues, are made clearer through real-world examples. Let's start with the danger of relying on short-term income support using Eagle Hospitality Trust, or EHT.
Ah, yes. EHT was famous for promising those really high forecast yields, 8 to 10% right at the IPO, wasn't it?
It was. But that yield was explicitly supported by a short-term income guarantee from the sponsor. When the sponsor ran into trouble, and then tourism evaporated during the pandemic, that support ended. The cash flow disappeared.
And the result?
The REIT collapsed, filed for Chapter 11 bankruptcy, and investors lost nearly everything. The lesson is simple and brutal. Yield support is not genuine, recurring cash flow.
Okay, lesson learned there. We saw similar sponsor-related danger with First REIT, but in a different way. It was extreme over-reliance on a single entity, right?
Yes, First REIT depended heavily on master leases with fixed escalation rates provided by its parent company, Lippo Karawaci. When that parent faced severe financial strain, they demanded lease renegotiations, slashing rents.
Ouch.
As a result, First REIT's DPU plunged by about 70%. If your entire yield relies on the financial health and, frankly, the good grace of one sponsor, you have massive single-party counterparty risk.
Huge risk. And let's look at Sabana REIT. That's a classic example of the inflated asset trap combined with guarantees.
Yeah, Sabana REIT illustrates the IPO allure perfectly. The assets were sold to the REIT at what was arguably an inflated price, but that was sort of masked by a 7-year master lease guarantee that artificially juiced the rents to promise that high 8% yield.
And when the guarantee ran out?
When that guarantee finally expired, the actual open market rental income plunged by 50%. The initial high yield was merely a promotional hook. We also saw cases like Lippo Mall's Indonesia Retail Trust, LMRT, which used perpetual securities and paid distributions partly from capital reserves to mask rapid deterioration.
Okay, this brings us to perhaps the most critical takeaway tool for you, the listener. Based on all these tactics and failures, what is the ultimate 6-point checklist? What are the absolute non-negotiable red flags you must watch for when researching a high-yield REIT?
Okay, if you see a high yield, look immediately for these 6 signs of potential financial engineering. Number 1, a payout ratio consistently above 100% of distributable income. They are spending more than they earn.
Red flag number 1.
2, large capital distribution portions in any dividend announcement. This means they are returning your capital, not their profits.
Got it.
3, DPU stability despite clearly falling net property income, suggesting constant top-ups are masking the underlying decay.
Hiding the problem. Okay.
4, frequent rights issues that are not matched by corresponding real DPU growth. They are constantly diluting existing holders for temporary relief.
Dilution danger. Number 5.
High gearing near the regulatory limit, say 50%, combined with the use of perpetual securities, indicating they have pretty much maxed out their debt capacity.
Okay. And the last one?
And 6, complex related party deals or sponsored leasebacks that obscure the true open market value of the rents and assets. Makes it hard to see the real picture.
That is an indispensable list for protecting capital. And finally, maybe a word of caution about due diligence, especially for overseas assets. We saw this with Manulife US REIT and EHT, both of which held international property.
Yes, that's a really important point. Investing in overseas assets, particularly in cyclical sectors like U.S. or European office and hotel space, introduces a massive due diligence challenge. When you are geographically removed and can't physically assess local market conditions, see the foot traffic, check the competition.
You're flying blind to some extent.
Exactly. You become incredibly vulnerable when local interest rates rise or economic conditions turn sour. Investors who couldn't monitor the local U.S. market for EHT and Manulife US REIT paid a very, very steep price.
So putting this all together, what does this all mean for your investment strategy? The ultimate takeaway seems simple. Don't just chase the highest percentage yield number. A 5% yield that grows sustainably year after year is vastly superior to an 8% yield that gets cut to 3%, or worse, leads to permanent capital losses exceeding 50%.
Absolutely. And what's fascinating here is that the sources show us that even strong blue-chip REITs can see their distributions drop by around 20% during a severe down cycle, like the recent high interest rate environment. But crucially, they recover and their underlying asset value stabilizes.
But the others?
Financially engineered REITs, by contrast, may stop paying dividends entirely, and the capital damage is often permanent and unrecoverable. You don't get that money back.
We've established that a strong, solvent sponsor is often the critical firewall for a REIT's survival when the market storm hits. This raises, I think, an important question for you to consider as you look at your own investments. How much risk are you truly willing to accept if the savior for your high-yield investment is only as strong as the next economic storm?
That's the key question.
We'll leave you to ponder that vital question for your portfolio. Thank you for joining us for this deep dive.